Everyone recommends The Intelligent Investor by Benjamin Graham as one of the first books to read when you start out investing. The book is full of good tips, but at this point it's slightly dated. Even so, it does give you a great framework. So the book is fairly bulky, and if we can skip some parts of the book, we definitely should. So what are the key points of this book? I'll let Warren Buffett set the stage for us.
I obviously recommend first and foremost The Intelligent Investor, with chapters 8 and 20 are the ones that you really should read. Well, all of the important ideas in investing really are in that book, because there's only about 3 ideas, and those two of them are emphasized in those 2 chapters.
So what are these 2 ideas that Warren Buffett is referring to? Let's start with the first one, Chapter 8, The Investor and Market Fluctuations. This can also be called Who is Mr. Market and How Can He Help You? Look at the following stock chart of Amazon. If you bought Amazon in August or September 2018, you would have broken even on that investment after the pandemic recovery, around May 2020. The same is true if you bought it in April or July 2019. On the other hand, buying it in December 2018 would have been a great investment. Same with several other times in this chart, but the point here being is the price you paid matters. And an investor should be prepared for fluctuations like this if you've invested in any company, both financially and mentally. Graham doesn't think that any investor can deal with price movements by forecasting them. Neither does he think that someone can time the bottom or the top, so you shouldn't even try. Benjamin Graham says that the speculator's primary interest lies in anticipating and profiting from market fluctuations. The investor's primary interest lies in acquiring and holding suitable securities at suitable prices. So what is a suitable price then? Graham believes that seeing the prices quoted of securities every day wasn't needed. I can imagine that he would like today's world even less than that. The suitable price should be coming from you. You should be able to say what the company is worth, based on the analysis that you've done. Don't let the market influence your thoughts on the matter. This is then where Mr. Market comes in. He is the psychotic bipolar drunk who tells you every minute of what he's willing to buy or sell your companies for. Most of the time you can ignore him, but sometimes he provides you with an opportunity to buy when prices fall and to sell when they go up. Chapter 20. Margin of safety as the central concept of investment. Building on the message from Chapter 8 about buying stocks at a suitable price, this is what margin of safety is all about. It is the gap between the intrinsic value of the company that you've analyzed and the price quoted at the market. A true margin of safety is not something that is abstract or a feeling. It is something that you can demonstrate with numbers and calculations. Graham also likes to point out that purchasing companies and securities with a margin of safety does not stop you from losing money, but it does help you to mitigate your losses. Warren Buffett has been known to say that there are also 2 rules in investing. The first rule is never to lose money, and the second rule is don't forget rule number 1. I suppose also here he was listening to Graham. If you have an idea of the intrinsic value of your companies, selling them with a large margin of safety can also help you take home profits when Mr. Market is having one of his enthusiastic phases. So these are the 2 key ideas that Warren Buffett think are the most important things in The Intelligent Investor. Controlling your emotions with regard to the market and purchasing stocks with a margin of safety. Thank you for listening. I hope you learned something today.